Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Claudia Sahm, yesterday in front of 1,600 people at the Marriott Marquis, we had a fantastic panel, and they mentioned Claudia Sahm. She is definitive on rational analysis of the American labor market out of Michigan. Chief economist, New Century Advisors, joining us now. Claudia, you write that the Sahm rule triggers at 4.5%. How distant are we from a 4.5% unemployment rate?
So I think we're months away from seeing that unemployment rate. It tends to take time for it to build. Unfortunately, I think that is where we're headed this year. So we could see something like that in the second half of the year.
Claudia, the question I think for a lot of folks here, when we look at this data here today on the jobs, and it's not going to give us much of a hint to the way employers are thinking about the job market today post tariff discussion, but what will you be looking at today's data?
Right. So, today's data matters. This employment report matters, not because it tells us what's going to be the effect of all the administration's policies, particularly with the tariff policies that we learned about this week, but policy happens in a macroeconomic context. We need this labor market to be as resilient and strong as possible to help workers and households weather this storm that's coming. That was absolutely crucial. We, in 2022, 2023, economists, many were saying recession is coming, recession is coming. We had some big policy changes, Fed raising interest rates, inflation was high. We did not have a recession. And a key to that was we had a very strong labor market that buffered it.
Right.
So it's really important, this context going in, even if the policy effects aren't there today.
Claudia, Danny Blanchflower up at Dartmouth just mentions your name in awe over the Michigan approach to listening to non-experts, to the Michigan confidence numbers and all that. Has President Trump broken the labor and investment confidence of America?
Well, and I will say Danny's done excellent work using those expectation surveys, Michigan survey, the conference board, to really, get a sense of, is a recession coming? So the Sahm rule is a lot about, is one here, but he's done a lot of work on what is one coming, and take those sentiment surveys very seriously, and it's ugly. Right now, we had an ugly period a few years ago too, where people were very downbeat. But again, we're back in this place where people are telling us, and businesses too, the outlook is pretty grim, and that's even before. I mean, that's
right.
Last month's surveys, right? That's not even this week's surveys. So it can be hard to interpret those data. Sometimes they can lead us astray, and yet there are real policy changes happening. And one thing with this quote unquote soft data is it can look into the future and give us expectations.
Okay. Claudia, stay with us, please. We're going to go to Dr. Sahm here after the data. Neil Dutta waiting on deck, who's been brilliant. Again, Dutta talking with Krugman. Professor Krugman will join us next week at some point. Claudia, completely unfair for you to go granular here on the jobs report. We'll let Neil Dutta do that. But do you take Jason Furman's going ecumenical on us with 7 moving averages. What does Claudia Sahm do? Do you look at the 2-month, the 3-month with revisions, the 6-month moving average? Which matters to you on non-farm payrolls?
Right. Well, you definitely don't want to focus on just 1 month of data. 3-month moving average is a good place to start. I will say, though, on the employment report in general, you just want to breathe it all in, right? You need to look at the payrolls. This is good. That was a solid read, even with the revision. The unemployment rate, we don't like to see it ticking up on utilization. So I'd say this is kind of a mixed bag, that the wage pressures aren't there. So at least we're not, pulling in another inflationary impulse here. So I think, generally this looks a lot like what we've been seeing from this labor market, which is it's in a good place. But it's not the firing on all cylinders that we would need to, go up against some of these changes.
And Paul, you're going back and forth with Jerome Powell. I mean, this doesn't move the needle for the Fed, does it?
I'm not sure. We'll see soon, though. But Claudia, here, how do you think, how do you think the labor market's going to evolve for the remainder of the year, given some of this uncertainty that's now brought into the economic outlook with all these tariffs?
Right. Well, so I think the labor market is going to get on a slowing trajectory. The thing is, it's one of the last places where this shows up. We're going to see prices start to move up pretty rapidly, and then you see consumers pull back, and then you see employers go from not hiring as much to not as many hours, so then they start laying off, and then it takes time for this to move, for a shock like this, like these tariffs, to move their way through the economy. And it's like if you wait until it shows up in the higher unemployment rate to do something, say like the Fed, you waited until
Right.
like we're past. So I think that's you don't want to look here first, the labor market, but the trajectory is not encouraging with the policy changes.
Claudia, to the silliness over the Sahm rule, and you've been very good about, the people speaking with certitude, trying to crystal ball a recession. Nobody knows, Claudia, where we are May 2nd, the April report, June 6th, the May report. Where would you guess the labor economy is the 4th of July?
Oh goodness. The answer to that question is going to hinge so much on what the administration does in the next few weeks, right? It really can't be underscored how like the duration of the tariffs, the breadth, like do we have retaliation? I mean, again, the outlook is not good, but it's like that is going to be so
Right,
important, and that's such a wild card. So I'll put a direction of unemployment rate will be higher. I don't know that we're breaking
right.
4.5 at that point. But I think that's the direction we're headed, unless there is a real pivot on the policy coming out of the administration.
Dr. Sahm, thank you so much. Claudia Sahm, we are honored to have you on each and every Labor Day with New Century Advisors, of course, definitive at Michigan and at the Federal Reserve. Neil Dutta with us a number of days ago, generous of him to come back on this Jobs Day. He's with Renaissance Macro. Neil, let's start with how you dovetail your work with Jeff DeGraff on the markets over at Renaissance Macro. Is the Neil Dutta world such a mess that DeGraff freezes, goes to cash, takes a hyper defensive position?
I mean, I think, Jeff is always looking for opportunities and, trying to look under the hood to see what other people aren't seeing. And I think he continues to do that. So, I think it's times like this, he's looking for, tentative evidence of a bottom.
The Jobs Day, 4.2%, I guess, of vectors in place. Claudia Sahm speaks of an important 4.5%. I asked this yesterday at the Game Forum, Neil Dutta. I would have asked it of you. Do you frame out a 5% unemployment rate given the festivities in the Rose Garden?
I don't know about 5%, but we're going up. I think we've been going up for a while. Obviously, given the shock to financial conditions that we've seen in recent days, that view is just amplified. But consumers have been telling us that things are getting worse for a while. So I had been largely expecting a fairly linear increase in the unemployment rate. I mean, you basically have, ongoing layoffs. I mean, they've been coming up modestly. The hiring rate has been very, very sluggish, and rates of job finding are low. And so that combination, has gotten us a fairly linear increase in the unemployment rate. The risk now, I think, is a more nonlinear increase in the unemployment rate because of what's going on. That, to me, is the risk that we need to be concerned about. Hiring rates are probably going to weaken. And, at the margin, I would say layoffs are getting worse because, just tariffs. I mean, it's like anything else with trade. I mean, the benefits are widespread with trade. The costs are very localized. And tariffs, it's the opposite. So the costs are spread out, the benefits are localized. My sense is that it's hard to argue that the shock to financial conditions won't, have some spillover into the real economy. And so, I think it makes sense to pencil in a higher unemployment rate forecast
Right.
going forward.
So, Neil, I know the administration labeled their tariff day Liberation Day, but I see in your note Happy Obliteration Day here. So walk us through the math here. Given the numbers that we do know, what do you kind of run through your model that could be a hit to GDP given what we know?
Well, a lot of these models, I mean, if you game out like, I mean, wherever the effective tariff rate was before and what these new tariffs imply, I mean, you're talking about an effective tariff rate. Basically, that's like customs duties revenues as a share of, or custom, as a share of imports. I mean, you're basically talking about, something close to 25% based, I mean, by our calculations. That represents, a little over, I think, a 1 percentage point shock to GDP. So I think that's kind of where, how most of these calculations are coming about. I would argue, though, that these calculations understate conditions, the hit to some extent, because you're just looking at a direct cost. You're not sort of including like what is the ramification to corporate confidence, household confidence, and sort of the spillover and knock-on effects. And I think that's why I think it could be even worse. But I mean, if these stay on, I mean, this is basically a recession-like outcome for the U.S. economy.
Neil, Dan Ives was in earlier. He suggests big tech will pull all guidance forward in their conference calls. How in God's name do you take an Excel spreadsheet and get the Dutta crystal ball out past the vicinity of April 15th?
No, I don't. I mean, to me, we're all just guessing at this point. Maybe you should have a game theorist come on with you, Tom. That would probably be the best person to interview. I mean, we sort of see these things in our international trade courses, looking at the dynamics of a trade war, right? This is sort of like the classic prisoner's dilemma, and we're kind of going through it, right? I mean, we're seeing the part where you see both sides retaliate, and you're at the worst outcome, and that seems to be what we're getting. And I do think it's interesting. I mean, this is sort of going a little bit beyond my wheelhouse, admittedly, but I found it interesting that the administration said it was wise for other countries not to retaliate because this would be some sort of cap. And yet, what do we see this morning? China retaliating, and I think Europe is probably next. And if that's the case, I think you have to really cross your fingers and hope that the White House won't also retaliate. But I'm not really holding my breath for that.
This is great. In ManQ Macroeconomics, 1,100 pages. Alan Blinder, 15th edition. Chapter 14, Paul, is cross your fingers and hope.
So, Neil, one of the things that's, I guess, concerning me, in addition to, kind of the math you ran through about what a tariff rate of 25%, what that would mean for GDP, it's just seems like noticeable decline in confidence, both consumer confidence and corporate confidence. How do you factor that into kind of economic growth and maybe inflation expectations?
Well, I mean, it's for consumer confidence, it's the speed of the decline, right? That to me is the big concern. I mean, consumer confidence has been quite sluggish for a while. Look, I mean,
right.
This is a shock to the economy, right? Like, so it's basically growth will slow down and reset at a much lower level. I think what you're going to see is basically the high-end consumer, which has been the core source of support for consumer spending over the last year, they are going to jack up their savings rate as a result of this. I mean, you're in a situation now where stock prices are going down, right? The elevated level of stock prices is one reason why net worth was rising relative to income last year, which is why consumer spending was so strong, because people drew down their savings as a result. You have the opposite situation now. So what do you think is going to happen with the savings rate? It's going to go up. As a baseline, consumer spending wasn't going to be really much stronger than 1.5% right now, because that's where real income growth has kind of been tracking, net of transfers. So we've already seen quite sluggish real income growth. So even a stable savings rate gets you that. If the savings rate's going up, you're going to have something weaker than that. So you can see already how it's very challenging to get to anything better than really. The best I can come up with is like a below potential growth environment still, right?
So maybe this jobs day wasn't what's to come in May and June and on forward, and some of the gloom, again, a 4.2% unemployment rate. But Neil Dutta, on April 10, when the Red Sox are in first place, on April 10, I'm looking at his CPI report. Is that move is lagged? Is the unemployment rate? Are we going to see stagflation CPI here in 6 days?
I mean, there may be some possibility that the inflation number surprises to the downside, in my opinion. I mean, you do have some improvement in some of these areas like eggs and so forth. I mean, you probably haven't yet seen the upward movement in car prices just yet, right? What we know about auction prices suggests that maybe car prices come in a little bit. So, March might be an okay month for inflation. And normally, I think that would probably give the Fed, some rope to cut or think about it. But it's all about the outlook now, and so the data doesn't really take on
Right.
that much importance.
What are you going to write about this weekend? Paul Krugman just emailed me and says, ask Dutta what he's going to write about. What are you going to write about this weekend, Neil Dutta?
I'm going to write about how I think the economy was slowing, going into all this trade war stuff, and that means that the administration doesn't have as much buffer as they thought they might have earlier. I mean, we talk about 228 on non-farm payrolls today. I mean, the revisions, I think, are what's important, right?
Yes, yes.
That's where you have the most confidence, right? So the fact that the revisions were down 50,000 tells you that they didn't get as strong of a hand as they thought they were dealt. And, arguably, this March number was just a payback from weather, right, in January and February. Right. So the underlying trend is actually somewhat weaker. So
Paul's been brilliant on this. Senator Moran of Kansas was just out on CNN. People are basically saying, where are the Republicans? Paul, you mentioned this this morning. Neil Dutta, if this goes away, do you sense that our trust, our confidence in our American exceptionalism is damaged?
If what goes away? I mean, yeah.
If the Trump tariffs go away.
If Trump tariffs go away, that means that...
is it a one-off?
I mean, that basically means that the president isn't as politically... it's a political nightmare for him, right? I mean, if you're betting on that, I mean, I don't know, Tom. I mean, I think, to me, I wrote about this quickly this morning. I think he believes he was spared an assassin's bullet to do what he's doing. So why does anybody think he's going to be backing off anytime soon? This is what he believes. Right. It's a core part of his political identity. If he backs off now, that's like unconditional surrender, which makes him basically impotent politically going forward. I mean, it's too soon for that to happen, in my opinion.
Neil Dutta, thank you so much. And thank you, President Trump, for listening to Surveillance this morning. Paul and I got to take a break. Paul's going to bring her in. Jamie Patton is out of TCW in Los Angeles. Every time she speaks, I learn something.
Of course.
Maybe in this crisis, we'll learn something.
I want to learn what her favorite...
When do the Dodgers lose?
Exactly. Yeah. I want to learn what her favorite sandwich was at Hoagie Haven in Princeton. She spent some time there. Jamie Patton, co-head of global rates at TCW, joins us. Jamie, what do you make of kind of what we're seeing out there in your market, the Treasury bond market?
It's been busy. I think... Obviously, risk markets are very disappointed by all of the tariffs, but treasuries are great again. So we love this move. We were much more confused by the initial reaction to a Trump presidency and tariffs and anti-immigration and all of that. There's nothing surprising about this. Tariffs are bad for growth. They're bad for the consumer. They're bad for the economy. They're bad. So this is the right market reaction. I'm a little confused why it took so long. It's like the market didn't believe what Trump was saying until not even Tuesday. Even when he said it Tuesday, it was really like Wednesday that market participants were like, oh, this is serious. This is bad. But his whole campaign and all up until now, he's been telling us what he's going to do. So I think, unfortunately, we need to believe him, which is great for bonds and great for TCW. We've been long duration, especially in the front end.
What should mom and pop do here with their fixed income? Take us away from the geniosity, Jamie Patton of Princeton, and derivatives and mathiness and all that. What do mom and pop do in fixed income over the weekend?
I'll tell you what I tell my parents to do, because
please,
that allocating into fixed income is a great idea right now, but you have to be really careful. So how we're positioned at TCW, we're long duration. We love that. We're lightening up just because we don't call tops and bottoms, and we dollar cost average in and out just to be prudent risk managers. But we're also still very underweight credit. So you can be long fixed income, but also in an extra defensive position, but you don't want to bleed out on carry. So at the same time, you can be underweight credit, long duration in treasuries. And then we're also long, we like agency mortgages. They're basically government guaranteed. They should do well regardless of risk on, risk off. Maybe you have a little bit of pain in the beginning of a risk off, but overall they're money good. So we like allocations to fixed income, but you have to be careful. Don't just go all into credit to pick up a few extra basis points. This is not the environment to just pick up carry.
So in terms of just kind of the markets here, talk to us about where you think, I'm looking at the 10-year here, 3.92%. Yeah. Where do we go here?
I think we still go a little bit lower. The 10-year is a good question because we still have this dynamic of nothing has been done to improve the deficit. We still have increasing term premiums and a lot of treasury issuance, so the curve could easily go a lot steeper. So if you're choosing your long duration position, we still like concentrating that more towards the belly and the front end. And what I mean by that is 2s and 5s. But overall, this is a bad situation. The Fed's in a terrible situation. They have high inflation, but not the good inflation, not the demand-driven inflation where they need to cool the economy. And then they have a terrible growth situation. They should be at neutral. They should have been at neutral a while ago. So we're watching a policy mistake happen, but they're too scared to lower rates when they see scary inflation numbers, especially.
It's off your remit, but I know you're down at Michael's in Santa Monica doing this. I mean, at TCW, are you modeling in an aggressive Fed of 3 and 4 rate cuts this year? I mean, I know it's not your game, but come on, you're talking about it, Jamie. Are you doing that?
It is my game. I love telling people what to do, whether it's my job or not. So
I'm shocked.
We think these Fed cuts, it makes sense that they're pushed out the curve, but we don't think they'll be priced out. So as the Fed cuts get pushed a little bit further away, they're going to have to cut more and faster. So if they had been a little bit more conservative and kind of gotten back to neutral when we think they probably should have, which was over the past few months, then they wouldn't have had to cut as much. But they're going to wait. They're going to be too high for too long. And then it's going to be a larger than expected problem, and they'll have to cut more. That's why we keep a little bit of our long, even though we are lightening up.
Jamie Patton, TCW, thank you so much from the West Coast early in our morning. Really, really appreciate that.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're thrilled that Dan Ives could be with us today. He's not on a plane, not in a hotel room somewhere, not watching Penn State in the Frozen Four. He's here. Everyone, Dan, I'm going to cut to the chase. You and I have been here before. Is the opportunity still there in Mag 7 for the brave to acquire shares this morning?
Look, I'd say yes and no. I mean, like Tom, my view is like 25 years doing this, and we've talked about this for decades here. These are always opportunities. My long-term view of tech. Trump tariff is an economic Armageddon if it stays in its current form. In my view, it changes the whole tech paradigm from a supply chain and from a growth perspective. And I think that right now is the scary thing. For the long term, of course, I continue to be bullish in terms of these. But look, this is a black swan event, what he single-handedly has done on a self-inflicted way.
Dan, I mean, what do you hear from the folks in Silicon Valley these days? Because, I mean, nobody made more of a pilgrimage to support this president than Silicon Valley, going against, decades of history. They're not getting much payback, are they?
And I think that's, to me, like talking to tech executives the last 48 hours, that's what's gotten me more concerned. Because when you talk to them, if there's some sort of broader plan, and instead, like, they're asking you what you think, and they, like, Tom, I don't think companies are I don't think Apple's going to give guidance on its call. I don't think a lot of these tech companies are going to give guidance because it is that uncertain. Because the reality is, like, look, 54% increase, that would destruct 10% of demand.
Stellantis is out there with layoffs in Windsor, Ontario, I think 2-3 days ago. I got Microsoft with 228,000 employees. Are you looking where Nadella and his team, look, these are the cards this president dealt us. We're laying off 6% of our people, 13,000 people.
you have to assume, and the assumption is it starts with this is some form of negotiation. Look, it comes
negotiation with who?
Again, if you take these tariffs at the way that they're laid out in that chart
right.
that is really viewed as a comedy show, then it's an economic Armageddon if the tariffs stay in its current form. And to some extent, you're essentially imploding Silicon Valley based on from a cost and supply chain perspective. The reason layoffs won't happen is these tech companies are going to be, okay, let's see the next few months. Let's ultimately see how the game's played, if this actually holds.
Right.
And then, but if we have these tariffs in place by the summer, it's all bets off.
So I think about some of these tech investments as big ticket items, long-term investments. I guess one of the concerns is, boy, if I'm just an executive in general, and I'm thinking about making a multi-million dollar, $100 million investment in some tech, hardware, software, I'm going to sit back here.
Well, the StubHub IPO was delayed.
Yeah.
I mean, just as one.
I'm just going to step back and
self-fulfilling prophecy.
Yeah.
And that's the word. And Tom, I would say for every month that these tariffs are in place, you take off another 10% of demand in the year. So right now you already have 10% in terms of what's already going to be baked in, 10% number cuts across the board.
Mark from Los Angeles emails in and says, ask Dan Ives about Apple. We'll do that, Mark Gurman.
Of course.
Right now. Okay, let's double barrel it. They're addicted to share buybacks. They cleared out with this plunge. They come out, they release a new announcement of share buybacks. And they've got, as I mentioned to Kathy Jones, they have to come out and issue debt now.
Well,
I mean,
I do agree on that front that they'll definitely go down that route. My thing is that it would take them 3 years to take 10% of the supply chain, move it to the U.S., and now it costs.
It's not going to happen.
20. So the point is, it's right now about the supply chain and what this is ultimately doing. But that's why for Apple, if you're a long-term shareholder and a long-term investor, you own it. If you're a trader right now, it can clearly go lower.
Paul and I are expert in analyzing Chinese supply chain dynamics from where? The bar at Michael's? I think that's where we do it. You actually go to China. Mm-hmm. What will Tim Cook do in the tit for tat between U.S. and China? Does he increase labor in China? Does he pull away? Do they push Apple out?
So first of all, pushing Apple out is basically impossible. Remember, Apple at peak is second biggest employer in China when it comes to iPhone demand. Look, the reality is that for Cook, and ironically, everything they moved to Vietnam, it's actually a higher tariff than China. So clearly, this is where that 10% politician, Cook, 9% CEO maybe goes to 50% politician, 50% CEO. You know, what types of ultimately exemptions do they get in terms of what they did in the U.S. from an investment perspective? Mnuchin talked about that as well. Like, do they get some sort of breaks? And I think for Apple, it just comes down to Cook is not going to change the long-term structural footprint of Apple because of these head-scratching tariffs, the way they were laid out, and ultimately to see how they play out.
Dan Ives with Wedbush, Kathy Jones earlier from Charles Schwab. We welcome all of you on your commute across the nation. Particular good morning to 99.1 FM in Washington. Heads spinning down there. So Senator Grassley of Iowa really fired up yesterday over what are we going to do about this. What we're going to do is bring you the conversation on this job day. Claudia Sahm, Neil Dutta with us later. Kate Moore in the 9 o'clock hour. Paul Sweeney continues with Ives of Wedbush.
Dan, realistically, when you talk to the folks in Silicon Valley, what, if any, can production in the tech supply chain can be brought back to the U.S. in reality?
In the next 2 to 3 years, basically 2%. No, I'm saying let's just talk about it would take 4 to 5 years to build a factory. From a cost structure, iPhones, if you built them in the U.S., would cost $3,500.
Okay.
I'm saying that. So the point is, like, every time, like, you know, investors, or when I'm in DC a few weeks ago, like, we need to buy them here. I'm like, well, look, the reality is that basically that would basically be imploding Silicon Valley. The way that it's built to the core the last 40 years.
Yep.
Okay, over the weekend, they're going to cave in. The market, right now, futures folks down 1,000, make the Dow futures down 2,000 points. We're under 40,000. Wow, on Dow futures, the VIX 39.17. The 10-year yield we mentioned with Kathy comes in. Where are we? My eyes are failing me on a Friday. It's Friday, right?
Yeah, exactly.
3.87%.
Yep, on your 10-year.
Dan Ives with us. This is going to get fixed over the weekend. Where is the Ives greatest conviction, single stock? Where are you buying an odd lot for Dan Ives? 1,000 shares.
Sure.
It's Apple and Nvidia. I mean, the two like if you have a horizon over 3 to 6 months, Apple and Nvidia, because the view is here is that what's being baked into these stocks is already a recession and already 10 to 15% numbers cuts. So if you get any deal, those are the names right here that you own.
What's the elasticity of revenue for Apple? I mean, it's been single digit. The Apple haters, the people, do you know there's people that hate Dan Ives?
Can't imagine.
It's there's complete Twitter accounts.
They hate his wardrobe. I'm in that camp, maybe.
It's, I got to get this in before we get to Penn State hockey. Okay, Dan, this is critical. They don't have revenue growth. That's almost to their advantage now, in that they're managing for cash flow.
Well, and then more and more, everything you've always talked about, now more of that cash flow. Because remember, that's going to not dramatically change. Now that valuation, that gives it a base case and what I believe a floor. I mean, I think where Apple's trading here, we are starting to be baking in almost a massive number cut relative to where the stock's going to open.
Apple down 5%, Nvidia down 4%. I don't care. Dan Ives, the only reason you're here, Penn State hockey, Frozen 4. How'd they get there so quickly?
I mean, look, Guy Gadowski and that team, Aiden Fink. I mean, if you look at it, I mean, Penn State hockey, it's probably been one of the best stories, not just
Are they all Canadian?
I mean, there's a lot of Canadian, but you do have a lot of U.S. as well, and I think they're gonna make some noise.
And by the way, the wrestling team won yet again.
It's an epic. Look, it's an epic year for Penn State across the board when it comes to sports.
But the football, the basketball, they can't win the big game. Does Frozen 4 have the same disease?
But it's the start of ultimately. First, I think we're gonna.
He's never coming back.
I think we ultimately. I think we can win this Frozen 4, and I think Keene, when we talk, once the tariffs get lifted, and then we're gonna be talking about Penn State 2025 national champs.
Can you imagine the elasticity if there's somehow this tariff madness is listed?
I mean, put this way. If this,
we've never seen this.
No. It will be, historical. But right now it continues to be a science experiment.
Did you see how when the market craters, he tones down the color?
Exactly. So real quick, you say this tech party, this ends at 4 a.m. It feels like the parents came in and broke up the party here.
Look, Trump basically came, broke up the party. Cops came, and at least for now, the party's off because Trump broke it up.
Dan Ives, thank you so much for coming in. Dan Ives with Wedbush.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Many talk, some do. David Blanchflower changed Atlantic economics out of England decades ago with a thin book out of MIT Press called The Wage Curve. Everybody had to stop and read it. And it was about the dynamics of labor, the dynamics of our wage, our inflation-adjusted wage. The thing about Blanchflower that's great is up in the sunny climes of Hanover, he could have retired like 15 years ago. Instead, we're inflicted with Blanchflower Bryson, which is him continuing his granular research forward on the American labor economy. Professor Blanchflower, thank you for joining us as we get out to the jobs report with Claudia Sahm and Neil Dutta. David Blanchflower, how bad is it?
Well, it's pretty bad. Take my role as well as the central banker. I think that the central bankers will be sitting there with unbelievable amounts of uncertainty, thinking, this is catching a falling knife. It does look like chaos, and it's unclear where this is going. Certainly, we're going to see some stuff in the labor market, and I suspect this will be the top of the cliff, probably. I think, think about if you were a central banker. On the one hand, you're worried about inflation coming, so you think, with that, I have to raise rates. you're also sitting there seeing the probability of a global recession coming, and you think, well, if that's the case, I have to cut rates. So we're really sitting here, waiting, watching, seeing how far this goes, and the stock forwards you were just talking about don't look good. So I think this is chaos.
Right.
I think there's no sense in which this makes any sense, and why you would want to impose an enormous tax increase on the American public, I don't know.
What's so important here, folks, and again, this formula is trotting out, thanks to Steve Ratner over with Joe and Mika, who did a really nice explanation of the absolute idiocy of this formula. The one who figured out that idiocy was James Sirowicki of the New Yorker magazine, and now at the Atlantic. Here's what Sirowicki says about David Blanchflower. This is akin to the quote, the wisdom of crowds, whereby the aggregate predictions of non-experts often produce more accurate assessments. David Blanchflower, what do the plain and simple non-economist Americans say right now?
Well, I've spent, and Claudia Sahm, we're going to have on in a while, she's been really good at this stuff too, but if you try and think about predicting downturns, and for the technically minded, I look at what did the NBR Business Cycle Dating Committee call a recession? So the question is, at the moment you're sitting at, what is the best predictor? And we'll go with two. The best predictors actually are essentially consumer expectations indices. Are they below 80? And the answer is both the Conference Board and Michigan surveys are looking in horrendous space. 7 of the 8 states that they report for are forecasting recession. And if you look back to 2008, this was exactly what you would see. But the second one, actually, Tom, that I'm really looking at is are there two successive months of employment declines, either on the household account or on the establishment account. So we saw a positive last month on the establishment account, but we saw minus 588 on the household account. So I'll be watching that very hard. Does that come in today negative? If it does, that's a big predictor of recession. So I think the likelihood is probably that the NBR will perhaps date a starting recession in April 2025, perhaps May. But I think we'll see that now. If the data comes in today, anything like that, the consumer confidence data has collapsed. I mean, that's where we are, I think.
And we'll have that for you in 21 minutes. Paul?
Professor, I know when we spoke to you last in November, we were talking about tariffs. You said the big questions are, what do other countries, what are they going to do? It appears that people aren't going to take this lying down. There's going to be some retaliatory tariffs here of substance. What does that mean?
Right. Well, that's right. Obviously, we've just seen China responding. And actually, I had a conversation with a guest you had on yesterday. We chatted last night, which is my colleague, Doug Irwin. And his view was actually that 2 weeks ago, his view was that everywhere would have actually responded like for like. And his view is this is also chaotic, that maybe what you'll see, I mean, obviously China's responded, but maybe some countries will actually sit and wait and watch and look rather than immediately respond, perhaps because Trump will step back, perhaps we'll see more evidence coming. So I think the answer is potentially you'll see many more places responding, but maybe for now, the sensible thing is go back to our conversation a minute ago about, what's coming, where are we? It might be that other places, I mean, the UK is an example, Japan's an example, they're going to sit and take a breath and think in the sense that, okay, if you did it, you don't have to do it this week. China's done it, and that's a really big deal. But, this is really huge amounts of uncertainty. And think about what the consequences of that are. Firms aren't going to invest and start building plants in the United States because of the chaos. Central banks don't know what to do because of this great uncertainty. So I think we'll see a little bit of, let's sit back and wait and decide what's the most appropriate. But that's Doug Irwin's view, and I think it's mine too.
Professor, I think we're starting to hear, and in this coming earnings cycle is going to be very interesting to see which companies provide guidance and which companies withhold guidance here, because it feels like not just consumers, but companies are also sitting on their hands and waiting.
Well, they are. I mean, I was actually just, the thing came across my terminal just a minute ago from the UK Institute of Directors. And it's quite interesting. They immediately did a survey of 600 odd members of the Institute of Directors, and 70% of them say that they expect their profits are going to fall as a result. So obviously,
Right.
firms are going to give different view. But if 70% of them think this is going to have a profit effect on them, they're going to sit and wait and watch. But you might
Right.
imagine they're going to impact employment. It's going to impact investment. And just go with a couple of quick things, just so listeners understand. Think of the basic. Blanchard and Irwin teach intro macro. What do we teach? National income is decided by C plus I plus G, right? Consumption plus investment plus government. Well, the situation we're in now, consumer spending's falling and sentiment's declining. Investment intentions are declining and the government's cutting spending. So how do we get anything
Right.
other than declines in GDP? The only issue, I think, is how big are those declines going to be? Are they just going to, reduce the expected
Right.
growth from 2 to 1, or is it going to go negative? And I think that's where we are. Hard to predict anything, but it all looks like the risks are to the downside.
Right.
And this government has to calm nerves.
Okay, well, folks, a vignette here. So Blanchflower calls me up. I'm lecturing the intro macro at Dartmouth. There's a bunch of muckety mucks going, who's the clown with the bow tie? And I look down in the aisle and Doug Irwin's staring at me, sitting on the floor of the aisle. And I've got to act philosophical. Okay, David, you've been through this with the Bank of England. It's about confidence and trust. I mentioned this yesterday. How close are we to I'm going to call it as a generalization, a Clement Attlee disinflationary United Kingdom analog?
Well, I don't know the answer to that. Think about, I think a good analogy, I thought you would ask me something like that. And a good analogy, I think now, is actually to look back at what Ben Bernanke just did. Ben Bernanke went to the UK, to the Bank of England, and said, let's think about how you model things. And actually today, these models essentially are thrown out of the window. And what you're going to have to do, and firms are going to do it, and central banks are going to do it, they're going to set up scenarios, Tom. They're going to have scenario 1, everyone retaliates. Scenario 2, Trump backs off. And you're going to sit and try and map out those scenarios and then try and think which of them is the most likely. Because you can't run a forecasting model. We have no prior data to look at this. So I do think the advice that I would give people is, wait, watch. Let's see where we are. Let's see when this thing bottoms out. Think about if people say you're going to buy on the decline, buy at the bottom. Well, we don't know where the bottom is. So I think that's the logic. And I think we're seeing that. You guys are great at tracking what's going on, but a falling knife, you just wait for it to fall. And I think that's where we are.
David Blanchard, thank you so much for joining us. The honor of having Irwin and Blanchard back to back in this crisis really helps. He is at Dartmouth College.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Gautam Mukunda joins us now with Yale, with all of his work, his wonderful book, Picking Presidents. And this weekend, we need an epilogue, or I need a chapter 7 here. Where do we go from here as a conclusion, Professor? Where do we go from here after Rose Garden festivities in the last 48 hours?
This is probably the single largest self-inflicted economic policy failure of any of our lifetimes, just no matter how far back you go. So we're in uncharted territory. The thing that really strikes me is, to an extent that we have not seen before with Trump, even in the first Trump administration, he just seems to be immune. He's not listening to other people, right? He's not listening to the feedback from the markets. He just seems to be immune to that. We can speculate as to what the reasons for that might be. But my guess is it's going to take him longer to back off the tariffs than people expect. And people who are anticipating the same sort of we're doing this, we're not doing this back and forth, I wouldn't want to take that bet.
Even before the tariffs, we've had this market kind of reflect on some of the economic policies here. If you just look at the stock market performance year to date in the U.S. in the first quarter was dramatically below the rest of the world, and that rarely, if ever, happens. Are you surprised? So the market has spoken. Are you surprised that members of Congress have not spoken about tariffs or perhaps some other policies?
So I'm not surprised yet. I will be surprised if this keeps going for a few months. Right now, the Republican Party is still completely unified behind Trump, and Republican representatives in the House and Senate care most about that. But this is going to start to hit, and I would think the biggest way in which the pressure will start to ramp up is they're working on these tax cuts. They want to do massive tax cuts again, despite, obviously the deficit consequences of that. And those tax cuts are focused, again, disproportionately on the wealthy. I think Democrats are kind of going around saying, hey, if you guys want to do the largest tax increase in human history, targeted primarily on the poor and middle class in order to pay for tax cuts for the wealthy, the politics of that look pretty bad to me, even if you're a Democrat and a Republican in a red state.
Rev up the script. We can do this with Gautam and Kundam. Now, you're coming from Boston. For those of you on radio, we've got the gorgeous backdrop. It looks like a Spielberg movie set of Beacon Hill to Charles River over to two universities of suspect ability. Professor Mukunda, as simple as I can, President Trump is against the people dining at number 9 Park on Beacon Hill. They're against the fancy people of Boston and coast to coast as well. You say the Republicans are going to stay with them. John Byrne Murdoch in the FT says they're already walking away. Do you anticipate, or is there a historical analog where the Republicans walk away from Donald Trump?
So there's a possibility. So what you saw in Andrew Johnson in the 1860s, where the Republican Party turned completely on him, and it was the Democrats who were his base of support. But for Trump, it is impossible to overstate the charismatic hold that Donald Trump has on the Republican base, right? For whatever criticisms you might make of Trump, his skill at crafting that is just unparalleled in American history. And if you're a Republican congressman whose basic concern is getting reelected, that's going to get really hard. That being said, maybe I'm being optimistic here, but I think there is a core of Republicans who are looking at the damage, and as much in the economic damage, they're looking at the catastrophic collapse in our position in the world, where essentially all of our allies are saying, not behind the scenes, right? They're saying on the record, they're saying things like, you're better off allying with China than the United States because at least the Chinese are predictable. Right? That is also got a bit of pressure on at least those Republicans who care a lot about foreign policy, and that's just something that we've never seen before, and the consequences of it are going to keep rippling out for years and decades. If Trump vanished tomorrow, we would still be dealing with this for a generation.
That's one of the most amazing statements of the week. You're saying, Professor, if we had President Vance, whatever, if President Trump removed tomorrow, this continues?
So I'm not saying that the economic policy might change, but the foreign policy effects will continue. So let's put this differently, right? So I used to advise the chief of naval operations and the senior military, and so right now there is the Polish or the Japanese version of me who's going and advising their Ministry of Defense and saying, we have wagered the existence of our country on the American nuclear umbrella for, quite a long, in the Japanese case since 1945, and the Poles since the end of the Cold War. And clearly that is not possible, because even if Trump weren't here, the Americans clearly like to elect people like this. So we need nuclear weapons of our own because it would be irresponsible not to have them. And that's not speculation. The president of Poland just said Poland should probably look at acquiring nuclear weapons because the Americans are no longer reliable. The consequences of that are going to be kept felt forever, because if I were Japanese, advising the Japanese Ministry of Defense, I'd say it is irresponsible not to do this.
So, again, I guess the question is, this is kind of where we are. Again, do you expect at any point pushback from some members of Congress? Because it does not appear that there's anything within the administration to check, if you will.
No, and I think the thing that might have started to break it was the Tuesday elections, where the Republicans, lost in Wisconsin and were closer than they should have been in Florida, despite the massive intervention of Elon Musk in Wisconsin. Sort of the joke I was hearing was that the inflation has gotten so bad that the wealthiest man in America can't buy a state Supreme Court seat anymore. And a lot of Republicans were being held in check by the fear, essentially, that Musk in particular would pay for primaries against them. If he is no longer able or willing to do that, or if his effectiveness is just decreased, that might free up some space to maneuver, but I wouldn't expect it to happen fast. The bond here is really tight.
I look forward here, and let's just simplistically say this, and I said this morning, folks, I'm repeating myself. At the Rose Garden, did President Trump lose the House?
So My guess is that just simple regression to the mean and the fact that the two bases of the parties have switched, so Democrats now have high propensity to vote voters and Republicans have low propensity to vote, probably meant that Trump lost the House the day he won the November election. The question now is this going to be so bad that the Democrats will be able to keep the House for multiple cycles? The last time that, as you know, you're hearing Republicans say this, not for attribution, but on the record, but where they're actually quoted. The last time we saw tariffs like this, Republicans lost the House for 60 years.
Right.
I don't anticipate that happening, but the politics of this, it's particularly striking, right? The people who will suffer most, both from the tariffs themselves and from the responses to the tariffs by other countries, are Republican voters.
Professor, dinner tonight at number 9 Park. Thank you so much.
I look
Gautam
forward to
Mukunda with us from Boston, of course, his affiliation with Yale.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We need a break. The newspapers.
Okay. Well, I'm not going to give it to you because we're talking tariffs this
you're
morning.
killing me.
I know. Just what you wanted. This one's in the journal. So it's an interesting look because it's talking about how President Trump's tariffs on China threaten to create this new problem for a global economy. They talked about this $400 billion surge of Chinese goods that are now going to be looking for new markets. And the problem is that the global market's already filled with these China-made goods. So then you have the domino effect, and that's what it talks about other major exporters like Vietnam, South Korea, Japan. They could see those similar issues. And economists are saying how the trade wars could escalate because of this. And one of them actually saying that the real fireworks are yet to come. So they're saying that this whole domino effect could start coming. Chinese imports slapped with that 34% duty. But this morning, we heard also that China is hitting back saying it's going to impose a 34% tariff on imports from the U.S.
Soybeans.
Among other things.
So farmers, okay.
And then they get aid from Mr. Trump.
Then they'll get the direct aid.
They get a check from Mr. Trump.
Yep.
I don't get it.
I don't get it.
Anybody in the control room get it? Ken, you get the soybean dynamics?
He does not.
Ken doesn't eat tofu. He said doesn't eat tofu. Next.
Okay, so we're sticking with tariffs. We're going to the grocery aisle,
You're killing
right?
me. It's a tariffs newspaper.
It is.
Here we go. What's going to cost you more at the grocery store?
Please.
Okay, because of this, all right? Parts of the store where the inventory has to move fast. That's where what's going to hit the hardest, like the produce aisle. You have bananas coming from Guatemala, right? Grapes coming from Peru. Okay, those are going to cost you more. Sugar, coffee, too, on top of it. Seafood, you can't get the nice fresh seafood. It's going to cost you a little bit more now. They're saying that tariffs are going to drive up the cost, even for Paul's favorite, those private label products. Those cheaper ones are even going to start to come up. And the opportunity for price gouging, they also talked about, which was interesting, is that they think that's going to start to get higher, too, as people start to take advantage of it a little bit.
Are they going to eat the tariff in their margin? That's the question. I don't see how.
I don't see
it.
And I remember,
the
obviously,
bigger companies maybe.
I remember back from the pandemic. I mean, we heard most of these companies, consumer packaged goods companies, said that they were able to pass along most of the price increases to consumer, and we certainly felt it at the supermarket as consumers. So, whether they can do it again, I don't know. But boy, that's, again, I don't know how this politically works.
Are you going to go from 3 shopping carts to 7 shopping carts this weekend at Costco?
That's what I'm saying. I'm going to start to purge.
You're going to front
I'm going to have to click
tariffs?
my cart and empty it. I've been holding on to the cart. I got to empty it now.
One more. What do you got?
Okay. This was from the Boston Globe. It's about the cost of education getting more expensive. Groceries getting expensive. Cost of education getting expensive. New England, right? It has some of the most prestigious universities, also the most expensive. You have Wellesley College. It's overall annual cost for undergraduates surpassing $100,000 in September. Crazy. Just over $69,000 of that is tuition. So you have room and board in there, textbooks, transportation, things like that. But it sounds like other private schools, they're really not far behind. Because if you look at Harvard, Boston College, Tufts University, they're going to be well above $90,000 next year. So it's just this thought of the prices of colleges keep on going. For most schools in New England, the actually total cost rose anywhere from 3 to 5% last year.
I read the only one that can afford it is the pitcher for the Red Sox. They just signed for $1 zillion dollars. What's interesting is a single sentence in that Boston Globe article that they see no lessening of applications.
The incoming class is going to be the largest ever. So people are still enrolling despite the high cost.
Again, having been at the board level of a couple of places, the cost structure for higher education is simply broken. It is totally does not work. You have to cut it in half, which you can't do because. But that's what has to happen.
We'll have to see, and we'll have much more on this. Thanks to our education team, David Gura doing some good work there with Janet Lauren recently. Lisa Mateo with the newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.